Welcome to Business with Louis, the show where we explore the world of business and entrepreneurship in a way that's both informative and inspiring. Today we're going to dive into a critical concept that every entrepreneur and business leader needs to understand: how inflation impacts business planning. In straightforward terms, inflation refers to the rate at which prices for goods and services are rising. It's a measure of how much more expensive it becomes to buy things over time. For businesses, understanding inflation is crucial because it affects not just the cost of producing goods or delivering services, but also how customers behave and make purchasing decisions. The concept of inflation has been around for centuries, with early economists like Adam Smith discussing its effects on economies. However, our modern understanding of inflation and its impact on business planning has evolved significantly, particularly with the development of monetary policy tools by central banks to manage inflation rates. At the core of understanding how inflation impacts business planning are several key principles. First, there's the concept of nominal versus real prices. Nominal prices are the actual prices we see on tags or menus, while real prices adjust for inflation, showing us the true purchasing power of our money. Businesses need to consider both when making decisions about pricing and investment. Another critical principle is the distinction between demand pull and cost push inflation. Demand pull inflation occurs when aggregate demand exceeds the available supply of goods and services, driving up prices. Cost push inflation happens when there's an increase in production costs, such as higher wages or raw materials, leading businesses to raise their prices. Understanding which type of inflation is prevailing can help businesses tailor their strategies. Influential thinkers like Milton Friedman have also shaped our understanding of inflation's role in the economy. Friedman famously argued that inflation is always and everywhere a monetary phenomenon, emphasizing the role of money supply in driving inflation rates. This insight is crucial for businesses as they navigate monetary policy changes and their potential impacts on inflation. During periods of high inflation, such as the 1970s in the United States, companies faced significant challenges in maintaining profit margins due to rising production costs. Businesses like Coca-Cola and Procter & Gamble had to adapt their pricing strategies, often implementing price increases gradually to minimize the impact on consumer demand. In more recent times, the low inflation environment of the 2010s presented different challenges. Companies like Amazon and Walmart focused on investing in technology and logistics to drive down costs, thereby maintaining or even increasing profit margins despite low price increases. This strategy allowed them to stay competitive in a low inflation market where consumers were highly price sensitive. Another interesting example comes from countries experiencing hyperinflation, such as Venezuela in the 2010s. In such extreme cases, businesses have had to adapt rapidly to survive, implementing daily price changes and using alternative currencies for transactions. These examples illustrate how critical it is for businesses to be nimble and responsive to changes in the inflation landscape. So, what practical applications and tips can you take away from this discussion? First, staying informed about inflation trends and expectations is essential. Following economic indicators like the Consumer Price Index (CPI) or the Producer Price Index (PPI) can give you a sense of where prices are headed. Second, consider investing in technologies or processes that can help reduce costs or improve efficiency, which will enable you to maintain your profit margins even if inflation rises. Third, think carefully about pricing strategies and how they may need to adjust over time. This might involve implementing price increases gradually rather than all at once, or offering discounts or promotions to maintain customer loyalty during periods of high inflation. It's also important to understand your target market's sensitivity to price changes and adjust your strategy accordingly. Finally, remember that inflation is not always a bad thing. It can also be a sign of economic growth and increased demand. By understanding how inflation impacts business planning, you can position your company for success in a variety of economic environments. In conclusion, the impact of inflation on business planning is a critical concept that every entrepreneur or business leader needs to grasp. It's not just about rising prices, it's about anticipating and adapting to changing market conditions, managing expectations, and making informed decisions about investments and resource allocation. That's it for today's Business with Louis. Be sure to like, share, and subscribe, and remember, every great business starts with action. Make your next move count.